In corporate finance, risk and return, they are very important concepts in decision making. We have here two concepts. We have the concept of risk and we have another concept of return. The risk in finance is a probability of loss. The risk is that uncertainty that the investor may not know today, but the role of the investor is to predict and identify those related risk to its specific investment. Here, when you want to estimate the risk, the first thing you need to take in your mind and you need to know is to know the expected return. The previous returns sometimes are calculated, the ones that we call historical returns, but those returns may not be the same actual returns. So it is now a paramount of the investor to know how to determine the expected return. There are two ways of estimating the expected return. When sometimes the returns have probability, and when the returns have no probabilities. When there are no probability of the historical returns, the expected return is calculated, and we say that it is a mean. And that mean of return is normally the summation of the return that will vary from I to t divided by n. N is the number of observation, while R are the historical returns. Now, when there is there are probability associated to the return, it's easy for you as an investor to calculate the expected return from that investment. The investment might have several events or several observations or several situations, and it's now up to you to assign probability. If the probability is not assigned, you assign. And the summation of all probabilities, they are equal to 1. Now here, the expected return, if the probability is given, it is the summation of the return, historical return, factor of the related or associated probability that will also vary from I to t. I are those years, and the t might be, for example, different assets. Now, when everything is known as expected return or the mean, arithmetic mean of the sample, you need to calculate now the risk. The risk is calculated by standard deviation. And here we remember that we might have two different assets. Now, the risk of one asset might be different from a risk of another asset. Now, when you want to calculate the risk of a return of an asset A, this is how we symbolize the risk. Now, the risk of an asset A, for example, will be the summation of the historical return I from I to t minus the expected return that you calculated times the probability associated to your return. This is used when there is probability associated to the return, or there are probability that are associated to the return. If there are no probability that are associated to the return, the risk of an asset is calculated by taking the summation of the historical return minus the mean that you have calculated squared divided by n minus 1. This is the risk of a sample. It means when you are taking an investment decision, you are using some sample data. But when you don't use a sample data, you will divide by n. It means it is a risk of an asset of a population. Risk of an asset of a population. Now, this is applied when we are having a single asset, not a portfolio. Now, dear followers on this YouTube account, I may now say that it's easy for you to determine now the relationship or the covariance. The covariance of an asset A and a B. Now, the covariance means you want to measure the co-movement. The co-movement of assets. The co-movement means those assets, they either need to move together or they need to move in parallel. The asset might be moved together. Asset A and B can move together. They move together or they move parallel. Or They move parallel or they move in opposite. The opposite, this co-movement will now allow you to know whether the risk of A will be the same risk of B. So the asset might either move together or they move in an opposite side. Now, when the assets are moving together, it is normally a positive relationship. When you have a positive covariance, it means those two assets are moving together. When you have a negative covariance, it means those two assets are moving in an opposite side. That is now what is interesting an investor. The investor would like to invest where there is those two assets are not moving together. Because when the assets are moving together, the risk that is affecting one asset will be the same risk that will affect another asset. Now, how do we calculate then? How do we calculate the risk or the covariance of an asset? The covariance of an asset. The covariance of two assets, it means when there is no probability. When there is no probability, the curve A and the B will be calculated by taking the summation of the return A minus the expected return of A, then factor of the return A minus the expected return B. Sorry, here B1, A1 minus the expected return of an asset B, then times the probability. So it means for you need to have the return of an asset A for the year observation 1, 2, 3, 4, and you also need to calculate the expected return of an asset A. Then you multiply by the expected return, historical return of asset B minus the expected return of that asset B times the probability, if the probability is given. If the probability is not given, you need to divide by n minus 1. This is how we calculate the covariance. After the covariance is calculated, you may now need to estimate what we call correlation. The correlation coefficient between asset A and asset B. Correlation coefficient between asset A and asset B. Now, dear readers, because here you have already estimated the variance, the variance of A, the variance of B, it's easy for you to know the standard deviation, the risk. The standard deviation might be now the square root of the variance of that asset A. And then here, the standard deviation will be now the square root of the variance of B. Now, if you want to calculate the correlation coefficient, it's now the quotient between, because the standard deviation is known, you may now be able to calculate the correlation coefficient, which is the covariance of AB divided by the standard deviation A times the standard deviation B. Now here, you will now have calculated the correlation coefficient. The correlation coefficient measures how the two assets are related. You know, at the market, two assets might be related or two assets may not be related. As I said previously, if you have a positive covariance, it is obvious that you will have a positive correlation coefficient. Now, a positive correlation coefficient means those two assets have the same risk. A negative correlation means those two assets might have different type of risk. So it means one risk may not affect another asset. Now, which is now interesting the investor. But this decision of an investor will depend on the risk behavior of that investor. There are some investors who are risk takers. Some investors are risk takers. Other investors are risk averse, so they fear risk. Others are neutral. Neutral means they don't have any position. For the risk takers, they may now prefer to invest where there is a high level of risk. For the risk averse, They will prefer to invest where there is a low risk. And for the risk neutral, they will now invest anywhere because they don't have any side. Now, for the risk taker, though he wants to invest at an investment with a high level of risk, but he will be interested to maximize the return. The same as risk averse, they are also interested to invest where there is a high level of return, but with a minimum risk. So this is now what we are trying to see on how we can calculate the covariance and how we can calculate the correlation coefficient. Now we have another concept that we are calling coefficient of determination. Coefficient of determination. Coefficient of determination. Now this coefficient of determination, the coefficient of determination measures the variability of the risk or the variability of the return at the market. Now, dear readers, you know that at the market there are some systematic risk. At the market there are some systematic risk, and the other risks that we call unsystematic risk. Those systematic risk, the systematic risks are those risks that an investor may not be able to diversify. So those are the risks that are not diversifiable. Not diversifiable. Not diversifiable. It means they cannot be hedged. They cannot be hedged at institutional level. They can't be hedged at the institutional level. They can be hedged at the national level. Those are the risks that you as an investor, as an individual investor, you can't control. What you need to do, you as an investor, is just accept it. When you have accepted, you will see how to invest, and you stay with such a risk. We normally call this type of risk country risk. Those are the country risk. An example of such risk, we can now say, for example, unemployment. An example of such risk, we can say inflation. An example of such risk, we can say currency risk. So you as an investor, you don't have the ability to manage those risks. What you have to do is to accept and see how they may not affect your investment return. Other risks that we are having here are unsystematic risk. Those are the systematic risks, you can control them. Those are the risks that are related to competition. Those are the risks that are related to the quality of the production. Those are the risks that are related to the customer care. Those are the risks that are related to the qualified staff. And those are the risks that are at the institutional level, that you as an investor, that you as a finance manager, you can now be able to control and reduce them at a level that you can now be able to minimize them, and they may not affect your return. Now, how will you be able to manage those risks? Some risks can be managed by avoiding. You avoid. You can accept. You avoid them. You accept them. You can transfer them. Risk transfer. You can accept them. You can transfer them. You can avoid them. You can accept them. Okay, but you can also reduce. Risk reduction. You reduce them. So those are the types of risk management technique that an investor may be willing to use if he wants to reduce the risk, or he wants to stay with the risk, or he wants to transfer those risks. Now, let me also go to a portfolio. Dear readers, dear followers, it's like you as an investor, you can now decide to invest in one asset or several assets. When we say one asset, we have called it a single asset. But you can, because you have a source of funds, you have cash, you can now decide, instead of investing in one single asset, you can now decide to invest in several assets. When you are investing in several assets, we call it a portfolio.
A portfolio means it's a group of financial assets. Group of financial assets. You can buy a bond at the market. You can buy a bond at the central bank. You also decide to buy a stock at the capital market. You can also invest in real estate. But here, dear student, because we are in corporate finance, we will be limited on bonds and stocks or shares. Now, a summation of bonds, summation of stock, summation of other fixed assets are what we call those are what we are calling a portfolio. Now, when you are trying to calculate the risk of a portfolio, will be different on how we calculate the risk of one individual asset. Now, as we said, because a portfolio is a group or a bundle of several assets, they may not have same weight. They have different weights. Those are having different weights. They have different weight. Those assets are having different weights, and those weights need to be calculated. The weight means the proportion. The weight are the proportion. The weight are the proportion. Now, for example, we have asset A, asset B, and the asset C. We have asset A, asset B, and the asset C. For example, the asset E returns are 20. Asset B returns are 30. Asset C returns are 50. It means the summation of the total returns, they are 7, I hope they are 8, they are 100, right? Now, what is the weight of A, the weight of B, and the weight of C? The weight of B will be 20 over 100. The weight of B will be 30 over 100. The weight of C will be 50 over 100. Now, it means you need to calculate the weight of every asset, of each asset, before you take a decision to calculate the expected return of that portfolio. After that expected return of the portfolio is calculated, you can now go further to calculate the expected, the risk of that portfolio. Now, as I said, it means that the portfolio, expected return of a portfolio will be the summation of the weight A times the expected return of that asset A. Now, let me recall it again. I've said that the expected return. I've said that the expected return of a portfolio, ERP, expected return of a portfolio will be the summation of the weights of A factor of the expected return of A plus the weight of B factor of the expected return of B, then plus dash the weight of N factor of the expected return of N. This will depend on the number of the assets that you have. Now, once this is known, the expected return is very easy. What is now next? The next is to calculate the risk or the standard deviation of a portfolio. Standard deviation of a portfolio. Let's say standard deviation of a portfolio. Let's take an example of two assets. For us here in this class, we will be limited of two assets. Because for the several assets, it can be done in advanced corporate finance. Now, if you want to calculate the standard deviation of a portfolio or a risk of a portfolio, you are supposed to know better what you need to know better on the you need to have your variance. You need to have the variance. That is the first step. Number two, you need to have the weight of each asset. Number 3, you need to have what we call the correlation coefficient of the two assets, asset A and asset 2. And then what you need to do is to take that that weight, the weight. So the formula is here. You will take now the weight squared factor of the variance, weight squared of the asset 1, factor of the variance of the first asset, plus the weight squared of the second asset times the standard variance of the second asset plus 2. 2 means 2 assets. Factor of weight 1 plus factor of weight 2, factor of the covariance of one of the asset 1 and asset 2. In other words, it means that you to be able to calculate the risk of a portfolio, you need to have the covariance. You need to have calculated the covariance. So it means it is the square root, the standard deviation, the standard deviation of a portfolio will be the square root of the variance of a portfolio. So it means the variance of a portfolio, it is that weight A squared, because I'm assuming the asset is A, the first asset is A, factor of the variance of that asset A, okay, plus the weight of the weight squared of the asset B, factor of the variance of the asset B. Okay, it's very easy. Then you multiply, you add. Then you add the weight of A plus factor of weight of B, then factor of the covariance of A and B. Here you will now be able to know the risk of a portfolio. The risk of a portfolio. So it means that here you cannot calculate the risk of a portfolio if you don't have the weight of a portfolio A, you don't have a weight of a of an asset B, and you don't have again the variance of A and the variance of B at the same time the covariance of A and B. So maybe next time after this class I will be able to share with you an example of demonstration. So thank you so much.